Hello everyone, Roman here, and today we're gonna discuss inflation and monetary supply. Welcome to our deep dive how printing money fuels inflation. Today we'll uncover the hidden mechanics behind the Federal Reserve, banks, and rising prices. Let's get started. It's not just the Fed. Where money comes from then? You might think that the Federal Reserve just prints all our money, but that's only one part of the story. The Fed creates base money through things like buying bonds. But here is the kicker. Commercial banks create most of our money in our economy. Every time they issue a loan, new money enters the system, like a magic, but with consequences. Federal Reserve creates base money. Commercial banks create most of the money through lending. Every loan equals new money injected into our economy. Fractional reserve banking. Only a fraction stays in the bank. Ever wonder how banks make so much money? It's called fractional reserve banking. Banks only keep a small fraction of deposit, like 10%, and lend out the rest. Those loans get deposited elsewhere else, and the cycle repeats, creating layers of new money from a single deposit. It's like a financial domino effect. Banks hold a small percentage, usually 10% of deposit, as a reserve. Remaining funds are loaned out, creating a new money. One deposit fuels multiple layers of loans. Money multiplier effect. More dollars, less value, or money supply equals inflation. So what happens when all the new money floods the economy? Ever wonder? More dollars chasing the same goods means prices go up. Inflation might not hit right away, but it compounds over the time, eroding yours and mine purchasing power. Just look at how money supply, or M2, has skyrocketed or compared to prices over the time. Let me see my charts. Where is my charts? Oh, here. Okay. So this is the M2 base money supply, and in May 2025 it hit $22 trillion. And you see, it goes back like 25 years, quarter of the century. You see, when 2008 global financial crisis hit, they print a little bit. It bumps a little bit. But in 2020, when pandemic hit, you see how the expansion of the money went up. In a matter of fact, 40% of the whole existing money in the system were printed in the last 5 years. So we're printing for 250 years, but in the last 5 years we printed 40% of all money supply. And this is the CPI. It comes from the Fed. You see, in 2020 there was literally no inflation. Pre-pandemic it was like 2-3%. Then it went to zero because we couldn't go out and spend our money. And then right after it shot up to 10%. But real number, I believe 20 or 25%. This is how printing of money works. So all the money started to chasing less and less goods. So purchasing power of the dollar became less and less. Okay, and this is our, more money chasing the same goods equals higher prices. Inflation might lag but compounds over time. This is the proof. You see, in 2020 we started printing all the money, and then with the lag, 21, 22, within 2 years our prices like went through the roof. Purchasing power erodes as money supply M2 grows. Unlimited money, unlimited risk. Fiat money like the dollars has no fixed limit, unlike gold or Bitcoin. Central banks can print endlessly to cover debts or handle crises, but this comes with risks. The whole system hinges on the trust and confidence in our currency. So here is the question to ponder. What happens when that trust runs out? Unlimited money, unlimited risk. Fiat money has no fixed supply, unlike gold or Bitcoin. Central banks can print endlessly to manage crisis or debt. System relies on trust and confidence in currency until trust runs out. Thanks for watching. Subscribe for more insights. Until the next one. Bye now.